Welcome to the Deep Dive, your custom analysis of the latest market movers. Today, you've asked us to unpack Albany International's Q2 2025 results. And, well, it's a fascinating look, maybe a bit frustrating too, at a company facing some pretty serious headwinds. We're diving deep into the numbers and the story behind them. It was a quarter that delivered a surprising mixed bag, left investors with a lot to unpack, and frankly, some serious questions about what's next.
Indeed. Yeah, you saw a revenue beat that, technically looked okay, but then the earnings miss that definitely raised eyebrows and I think shook some confidence. Management reaffirmed their full year guidance, which suggests a strong second half is supposedly on the horizon. But the market's reaction, well, that tells a very different, much more cautious story, almost like a show me moment for the company.
Okay, let's get right to those headline numbers then, just to paint the picture. Albany International reported revenue of $311.4 million. That actually managed to beat consensus estimates, surprisingly. However, the adjusted EPS came in at a pretty disappointing $0.57. That significantly missed the street's expectations, which were, around $0.73 to $0.77. And to add to that, GAAP EPS generally accepted accounting principles that also saw a notable drop, down to 31 cents from 79 cents last year.
Right. And that's really where this story starts to unravel, I think. While the top line shows some resilience, yeah, the bottom line pressures were significant. We saw gross profit around, say, $97.5 to $98 million with a 31.3% margin and adjusted EBITDA at approximately $52 million. Both of those figures are down from the prior year. This isn't just a miss. It's a pretty significant earnings shortfall. And it clearly signaled to investors that operational efficiencies are under some severe strain.
All right, let's pull back the curtain then on these numbers, see what's really driving them kind of under the hood. The company operates in two main segments: machine clothing, MC, and engineered composites, AEC. Both faced distinct challenges this quarter that really squeezed profitability. What were the main factors contributing to this profit lag? Were they truly one-off hiccups or maybe something more systemic brewing?
Absolutely. That's the million-dollar question, isn't it? So starting with machine clothing, its revenue was $181 million. That's down 6.5% year over year. This segment got hit by several things happening at once, it seems. Unplanned equipment downtime in a U.S. facility, a slower than expected ramp up of transfer production at their Durand facility that's part of their footprint rationalization plan, and then just general market softness over in Asia, particularly China. That Asian weakness included delayed machine restarts from a legacy customer. We also saw impacts from customer consolidations in North America, specifically hitting packaging machine production. So yeah, it was a confluence, really. Operational hiccups and regional demand weakness hitting MC. Makes it tough to pinpoint just one root cause.
That is a lot of moving parts for MC. And it sounds like some of these, particularly unplanned downtime and slow ramp up, should be within management's control, right? But then for the engineered composites segment, AEC, their revenue was $130 million, down 5.7% year over year, but it did show a 14% sequential increase from Q1. So some growth there. But what about the margins? What was the big impact there?
Right. While AEC had that sequential growth, yeah, its margins were really hit hard by these cumulative estimated completion charges, EAC charges. These totaled about $7.2 million for the quarter and $8.1 million specifically related to that critical CH-53K program. Basically, EAC charges are adjustments you make when the estimated cost to finish a long-term contract changes, often because of underestimation or unforeseen difficulties. And these adjustments, mainly driven by higher than projected overhead rates, they've been continuing to invest in their labor force and getting ready for program ramps. Management noted the CH-53K is, quote, a very different program, said has required more resources and taken longer to ramp up than they initially estimated, which led to underestimating those overhead charges. And on top of that, R&D expenses also increased, up to 4% of sales. That reflects an emphasis on material science and new business ventures, which, certainly puts pressure on the near-term bottom line.
So it sounds like a significant and maybe more costly than they anticipated investment phase for AEC. But when management says it's a very different program needing more resources, that does raise a bit of a red flag, doesn't it? Was this truly unforeseeable, or does it maybe signal some issues in their initial program bidding or risk assessment? Despite these big operational and margin challenges, we should note, Albany International did maintain its quarterly dividend, $0.27 per share, and they repurchased $50 million worth of shares in Q2. That brings the first half total to $119 million. They still have, $143 million in buyback capacity remaining too. Free cash flow also improved sequentially, which is good, positive $18 million in Q2, though the first half total was still down year over year.
Right. But the biggest question mark, I think, looming over these results is management's unwavering full-year guidance. Despite the Q2 miss, they firmly reaffirmed their 2025 guidance. Revenue, $1.165 to $1.265 billion. Adjusted EPS, $3 to $3.40. Adjusted EBITDA, $240 to $260 million. Now, this implies a notably stronger second half of the year, which feels like a big leap of faith given the Q2 results. Is this just standard CEO optimism, or do you see the genuine, tangible proof points that maybe the market's missing?
That's a fair question, and it's certainly where you see the disconnect between the market and management.
Right. Yeah, management is banking on several factors for that second half recovery. For the MC segment, they expect a significant chunk of the Q2 production shortfall to recover, driven by what they call Heimbach synergies. That's efficiencies from their recent acquisition and, well, fixing those operational issues they identified. Their global MC order backlog, they say, remains healthy. So that provides a foundation. In AEC, they anticipate continued ramping of key programs. The CH-53K program, despite those EAC charges, is supposedly taking a very controlled approach to ramping up. They've invested in leadership, operator training, already showing improved output and reduced scrap, according to them. They're targeting a production rate of about 2 aircraft per month by year end. Parts are currently in all the jigs, which they believe is a positive trajectory. The challenge, of course, is that investors have heard similar stories before. The proof will be in the actual Q3 and Q4 numbers.
Right. Seeing is believing. Beyond the CH-53K, what other programs are expected to contribute to AEC's anticipated growth? What gives management this optimism?
Well, they also highlighted growth in commercial programs, like the LEAP engine program. That's now at contractual inventory levels, aligned with Safran's production schedule. So that's positive. The Bell 525 program, that's an attractive new win where they say they're already delivering to customer expectations. And the JASM program continues to grow with 100% on-time delivery, which is good execution there. Furthermore, they're seeing increased activity in hypersonics and expect strong demand in the advanced air mobility market with their key customer Beta. And internally, that big S4A Asana system upgrade was successfully completed back in May. They expect that to improve operational efficiencies and analytics going forward. So a mix of program ramps and internal improvements.
Okay. Analysts on the call, though, they certainly pressed management pretty hard on the wide guidance ranges. And more critically, the decision not to lower the full-year outlook given that Q2 performance. What was management's take on that market skepticism? And how credible is their whole poised to deliver stance right now?
Yeah, management really insisted on their confidence. They cited gradual progress they're already seeing, things like reduced quality issues, less hours spent per operation on programs like CH-53K. They basically articulated that the Q2 issues were largely timing and operational, and they believe they are poised to deliver on their second half projections. However, the market reaction clearly suggests that confidence is far from universal. The CH-53K situation, it kind of reminds me of a similar program back in the late 90s. Initial delays were dismissed as just teething problems, only to balloon into multi-year setbacks. It's sort of a classic defense industry challenge, isn't it? Management will need to show really tangible execution, not just promises.
That's a really good point. So let's connect this to Albany International's long-term strategy then, especially given their focus on innovation. They've been talking a lot about their 3D woven composite technology. Sounds like a potential game changer. But these operational challenges in AEC clearly show that innovation without flawless execution can be, well, a double-edged sword. Is Albany International truly set up to scale this revolutionary tech? Or are these current hurdles maybe a warning sign? What's the real significance there?
That's precisely the tension point, yeah. This 3D woven composite technology is a key differentiator for their AEC segment, no doubt about that. Albany International is heavily focused on leveraging it as a superior alternative to titanium in aerospace structures. It offers stronger relative strength to weight benefits and significantly reduced light times compared to titanium. And titanium, as you know, is currently facing its own supply chain challenges. We saw examples showcased at the Paris Air Show, things like braces for the A350 landing gear, lift blades for Beta's advanced air mobility aircraft. They're also applying this technology in hypersonic parts development. Certification for some applications expected within 18 months or so. This positions them incredibly well for both new military and commercial aircraft programs, assuming they can get the production and profitability in line. The potential is definitely there, but yeah, current execution issues could delay actually realizing that potential.
And amidst all this, we also saw a significant leadership change announced right around the earnings call. Willard Station was appointed as the new Executive Vice President and Chief Financial Officer effective September 1st. What impact do you anticipate this new CFO, with that deep background from Boeing, will have on the company's financial discipline and maybe their ability to deliver on these ambitious second-half targets.
That's a critical point, absolutely. Station brings extensive experience. McKesson Medical Surgical, SVP of Primary Care Sales, previously CFO there, plus a 16-year career at Boeing, including roles like VP and CFO for commercial derivatives airplanes. This appointment really aims to strengthen financial governance and forecasting, which frankly will be crucial following this quarter's earnings miss, particularly with those persistent EAC charges. A fresh set of eyes on cost structure and forecasting could certainly inspire some confidence, but, it'll take time to see that translate into tangible improvements on the bottom line.
Right, it takes time to turn the ship. So given all these moving parts, the challenges, management's confidence, the strategic plays, what are the key catalysts? What could actually drive Albany International's performance in the near to medium term and potentially reverse this negative market sentiment?
Well, the market's going to be watching for several concrete proof points. They won't be easily swayed by promises alone this time, I think. First, the actual execution and recovery of machine clothing operations needs to be against the plan in Q3 and Q4. Second, consistent production proof points and an improving margin profile for the CH-53K program. We need to see those EAC charges stabilize or ideally even reverse. Third, any new program awards or extensions, both defense and commercial aerospace, that always helps. Fourth, the continuity of dividends and the pace of share buybacks, those are important signals of financial health, showing management's continued belief in the company's value. And lastly, any upward revisions by sell-side analysts to their earnings estimates post-Q2. That could signal renewed confidence, but again, that will require tangible, demonstrable improvements from the company first.
Okay, let's connect this to the bigger picture for a second. Albany International operates in the industrial sector relatively steady, and the aerospace and defense sector, which has seen really strong year-over-year performance, right? The ITA ETF up over 40% in the last year. How has Albany International stock actually performed within this generally positive backdrop? And what does that tell us about the market's current perception?
Yeah, unfortunately, AIN has significantly underperformed both its sector and the broader market benchmarks. Over the past year, it's down approximately, 28% to 31%, somewhere in that range. And the immediate market reaction to these Q2 results was brutal. A sharp drop of 23.6% by the next close, on extremely high trading volume, too. That indicates a very cautious and frankly punished market sentiment. It's clearly driven by the significant EPS miss and these ongoing margin and execution hiccups, particularly with those EAC adjustments. Analysts have already moved to more neutral stances. There were multiple downgrades right after the call. The market's focus has clearly been laser-focused on near-term profitability issues, and it's largely outweighing management's optimism for that second-half recovery. Suggests the street is taking a definitive show-me approach here.
This disconnect, between management's optimism and the market's skepticism, it naturally raises questions about where the stock goes from here. Let's shift gears now. It's time for our This Is Not Financial Advice segment.
All right, Investment Committee, let's talk Albany International, AIN. Look, the market has absolutely hammered this stock post-earnings, and frankly, that EPS miss and those persistent CH-53K EACs, they were painful, no denying it, but I actually see a contrarian play here. My proposal is a long straddle on AIN expiring January 2026, targeting strikes around $60.
A long straddle. Quite the move, given the market's current stance. Tell us why you think this makes sense for our listeners. Why bet on volatility?
Because we're essentially betting on volatility driven by two distinct, yet I think equally plausible outcomes playing out over the next 18 months or so. Scenario A, the control ramp miracle. The upside. Management is incredibly adamant about a strong second half, right? Heimbach synergies, MC recovery, that very controlled CH-53K ramp. And it's a big if, but if they actually hit their targeted 2 per month rate by year end, and those EACs finally stabilize, we could see a dramatic re-rating of the stock. Plus, the new CFO, Willard Station, with his deep Boeing background, he officially steps in September 1st. A fresh set of eyes on cost structure, on forecasting, that could inspire significant confidence. If he articulates a credible path to margin recovery for AEC, especially on the CH-53K, then that whole 3D woven composite story, the titanium replacement angle that got positive buzz the Paris Air Show, that suddenly gained serious traction. This stock is currently trading at a steep discount to its sector peers. Any genuine positive news on execution could send it soaring. The market's short-term focus on the miss has, I think, created a substantial opportunity for a bounce if Q3 or Q4 show real operational improvement. Scenario B, the underestimated headache reality, the downside. Conversely, if that full-year guidance proves to be, a pipe dream, Perhaps the MC recovery is slower than anticipated. Or, more critically, the CH-53K program continues to be a cash sinkhole. More EACs, further ramp delays, then this stock has even further to fall. The market has already punished it severely, yes, but if that controlled ramp narrative completely unravels, investor confidence will just evaporate entirely. A transition year could easily become a transition decade in the eyes of the market if they fail to deliver on that promised second-half recovery. Furthermore, if the new CFO identifies deeper systemic issues that necessitate a guidance revision downwards in Q3 or Q4, the stock could easily retest prior lows or maybe even break them. Industrial stocks are generally stable, but company-specific execution failures like this, they get heavily penalized. And this company, has a bit of a history there.
And the January 2026 expiration date on that straddle, that gives you enough runway for these two opposing forces to fully materialize.
Exactly. Yeah, that gives us enough time for these really high-stakes narratives to truly play out. It allows management either to definitively prove their confidence in a strong second half, or for the market to further punish what might be seen as a failing strategy. The current undervaluation, combined with this high-stakes execution story, it just creates the perfect environment, I think, for a long volatility play. We're essentially buying a lottery ticket on the company's ability to either massively succeed or, well, spectacularly fail in their operational turnaround over the next 18 months.
Okay, so to recap then, Albany International is really at a critical juncture, navigating operational challenges in its machine clothing segment and significant profitability pressures from the CH-53K program within engineered composites. Management maintains confidence in a stronger second half, reaffirmed its full-year guidance. But the market's severe negative reaction underscores that lingering skepticism about the timing and the extent of this recovery.
Right. The leadership transition at CFO and those ongoing strategic initiatives, particularly in 3D woven composites, they offer potential long-term value drivers, no doubt. However, near-term performance hinges squarely on improved execution and margin stabilization across both segments. So the question for you, listening, is maybe not just whether Albany International hits its Q3 and Q4 numbers, but whether this entire episode highlights a more fundamental challenge, a challenge for any company promising cutting-edge innovation in complex sectors. How much lead time do investors truly owe them before a transition year risks becoming, a permanent state of underperformance? Something to think about.
Remember, this is not financial advice. We strongly encourage you to conduct your own thorough research and analysis before making any investment decisions. Thank you for tuning into the deep dive. We appreciate your interest in being well informed.